What should I look out for with the gold price? What drives it? It's a question I get asked a lot. It won't surprise you that there's no one thing, but there are a few things I'm going to tell you about that you might find useful. So keep an eye on these. It could help you make a lot of money. Let's try and keep it simple and look at 4. I find acronyms are a useful way of remembering things. So let's use M.I.D.I. It stands for market uncertainty, inflation, debt, and interest rates. First up, market uncertainty. This can take many different shapes and sizes. On the one hand, it can be such things as tariffs, as well as the general state of the economy. Everything is interconnected. For example, if the economy is doing particularly well, you'd expect there to be an upward rather than downward pressure on interest rates to calm things down a little. On the other hand, tariffs could well hurt the economy. No one knows, hence the market uncertainty. Whilst on the other, it could be about wars. Although it's impossible to say what exactly constitutes market uncertainty, events in the US seem to have a significant impact on the gold price. So if an action by the US leads to market uncertainty, it could well impact the price. Secondly, I want to talk about inflation. Now bear in mind that the gold price goes up and down, whereas inflation only goes up. But gold is often viewed as a hedge against inflation, a way of helping you maintain your purchasing power. If inflation is running high, then people tend to want gold to try and keep their purchasing power. You're probably wondering what constitutes high inflation. That's a difficult one, but as a very general rule, I'd say that if the level of inflation is higher than what you get from having cash in the bank or a government bond, then you can view it as high. For example, if your inflation is running at 2% and you can only get a 3% return on your cash or bonds, I'd say it's low. But if inflation is 3% and you can only get a 2% on your cash or bonds, I'd say it's high. Inflation is reducing your purchasing power. Next up is debt. Here is a chart that compares US debt levels with the gold price. As you can see, over the longer term, as debt has gone up, the black line, the gold price, the gold line, has followed. I'm yet to hear a sensible argument that debt will be coming down anytime soon. So if debt continues to rise, then over the longer term, the gold price could well follow suit. Finally, we need to talk about interest rates. As gold does not yield anything, the lower the interest rates are, the less you're losing out by holding gold. For example, if interest rate cuts mean that you only get 2% rather than 3% on your cash, you're forgoing less by holding gold. If people don't feel they're missing out, they're more likely to hold it. Higher demand leading to a higher gold price. Let's reiterate these 4 things. Market uncertainty. Inflation. Higher is invariably considered to be better for the gold price. Debt. Increasing debt often leads to a higher gold price, but please bear in mind that the gold price goes up and down. Interest rates. Lower is often viewed as better for the gold price. Please go to my website, Gold Program, to find out more.